All right, three, two, one, boom. This is a nice opening shot here. A little fall foliage cast on the ground here. Oh, back shot there of Boom U and Bloom U. Nice little shot here. We're going to scan over. You get to see the lovely library there at Boom U and Bloom U. And we're going to use this little background as a perfect setting to read about a Chesapeake update from the Wall Street Journal. And we'll just I think we might try and sort of keep the shot right here that seems to offer a nice little look, but we may bring it up this way and then see if we can't drop the Great Reading Hall in the background. We may just hold it right here. I think we'll probably just hold it right here, and I'll just read to you about Chesapeake. It's a pretty interesting story. You probably won't find this one in the Daily Oklahoman, but oh, by the way, this is Energy Boom 101. This is the second part of our series today on the Jack Frost's autumn arrival at Bloom U, and you can probably hear the wind rustling in the trees. There's a lot of students out and about. Boom U's definitely in Bloom U mode. There's some shimmering golds and some fiery reds and some other cheesy cliche words, but we'll try and think of some new stuff here as we're inspired by the passion that swirls amongst the minds of Boom U. Speaking of passion swirling, so here's the Wall Street Journal's article on Chesapeake Energy. And here's your update as you enjoy this glorious little sweep of activity amongst the autumn days. It's in Thursday, November 7th's paper, the Wall Street Journal. It's by Daniel Gilbert. Chesapeake, the headline, Chesapeake's plan sparks questions. Okay. Chesapeake Energy Corp is cutting costs after years of liberal spending, but the natural gas company's newfound thrift is raising questions about its growth prospects. Okay, well, let's find out. The Oklahoma City company, which shelled out the billions of dollars more than it made from operations in recent years, spent 45% less to drill wells in the third quarter than a year earlier. Chesapeake still managed to boost oil production by 23%, helping the company swing to a profit of $202 million. All right. New chief executive Doug Lawler told investors on Wednesday that oil production from the Eagle Ford shale in South Texas, you've heard of the Eagle Ford, apparently they have a pretty high output of light sweet oils, I think. But the Eagle Ford shale in South Texas would be lower this quarter, ending a streak of increases. The company is selling some producing wells, and rain has stalled some activities, he said. Continuing now, Mr. Lawler, who took the reins in June, said production would rise next year, including in the Eagle Ford. He declined to say whether that increase would be absolute or after accounting for sales of oil and gas wells. Don't get caught up in all this. Here we go. Chesapeake shares fell 6.8% on the news, so apparently it looks like if you were to infer that this news was what indeed drove the stock sell-off. Someone's yelling behind me, but who knows? They're probably changing currency over there. Chesapeake shares fell 6.8%, and they closed at $26.23 on the New York Stock Exchange. Great. The lack of details about future production spooked investors, analysts said. Here's an analyst quote. "There's some confusion on what growth is going to look like," said Mike Kelly, an analyst at Global Hunter Securities. "The jitters illustrate some of the challenges Mr. Lawler faces in transforming Chesapeake." The company disclosed Wednesday evening that it received a subpoena in September from the Michigan Attorney General's office to related possible violations of the state's criminal solicitation law, yada, yada, yada. The company has been responding to inquiries from Michigan and U.S. authorities for possible antitrust violations stemming from accusations by Michigan landowners that Chesapeake colluded, great word there, colluded, with Encana, big Canadian corporation, to keep a lid on drilling lease costs. Both companies have conducted probes of their Michigan leasing activities and determined that they did not violate antitrust laws. Chesapeake didn't immediately respond to a request for comment about the subpoena. Encana and the Michigan Attorney General's office declined to comment. So the Michigan Attorney General's office declined to comment. Pretty interesting there. All right, so let's continue here. Mr. Lawler has mapped out a strategy of spending only as much money as the company brings in. Interesting. Okay, so this is a totally different shift in how he's going to run this company from Mr. McClendon, who would spend a lot more money than he was bringing in, which is A-okay with me, and we'll get to that later. But this is Doug Lawler, who came in from Anadarko, and he's going to run a much tighter ship, and I will reiterate my buy on Chesapeake for what that's worth. Probably not worth a whole lot. This camera seems to be moving pretty good, but I think it's capturing, the boom and bloom, the boom you and bloom you. Okay, Mr. Lawler has mapped out a strategy of spending only as much money as the company brings in. Increased production will come from drilling the best prospects, while leases on less lucrative properties will be allowed to expire. Check that out, less lucrative. They still make money, trust me. They just make less money. They'll be allowed to expire, so he'll sell those off. The company is changing its spending strategy to, quote, ensure that all of our dollars are directed to where the best returns are achievable. All right, God bless him. Nothing wrong. That's what he's supposed to be doing. Growth had never been in doubt under Chesapeake's previous boss, co-founder Aubrey McClendon, who led a debt-fueled buying spree to secure drilling rights for shale rock formations across the U.S. That push made Chesapeake the country's second biggest producer of natural gas after ExxonMobil. Let's spin back this way a little. But falling natural gas prices left Chesapeake with a hole between spending and cash flow that widened to more than $8 billion last year. The company sold assets to cover the shortfall, but activist shareholders, Carl Icahn and the fellows out of Memphis, insisted on more fiscal discipline and overhauled the board. Mr. Lawler narrowed the gap between cash flow and drilling and leasing costs to within $200 million in the third quarter from $2.3 billion a year earlier. So quite the gap there he's been able to close. Chesapeake, which laid off 800 employees last month, has cut administrative and operating costs. Total debt, net of cash on hand, fell to $11.7 billion from $12.4 billion in the second quarter. The changes had been well received before Wednesday's sell-off, which with Chesapeake shares up 36% since Mr. Lawler's first day in the job. So look at it this way. Mr. Lawler arrives, big Wall Street money, is happy with that. They drive the shares up 36%. It gets a little correction a few days ago based on some Eagle Forward notes, big deal. Let me continue this final paragraph and we'll shut this down for this part 2. And that is that some analysts, and this is a continuation of the article, this is final paragraph. Some analysts called Wednesday's share drop an overreaction. Here's a quote. The minute you slow down capital spending, it shouldn't surprise most people that your production rate isn't as robust, said Mark Hansen, an analyst at Morningstar. So there you go. There's a little update while you're enjoying this glorious boom you and bloom you. We're going to get you another shot of the foliage here. This is the second part, and this also was accompanied by a lovely story on Chesapeake. And that's it at 8 minutes. See ya.